Welcome to the Financial Freedom Mastermind Group podcast. Here we're all about breaking free from the 40 to 50-year work grind and accelerating our journey towards financial freedom. Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast-track your path to financial independence. We serve as a hub for connecting with fellow members during our sessions so you can share successes, ask questions, and keep the momentum going.
Good evening, everyone. My name is Adewale, host of the Ekabo Home Financial Freedom Mastermind Group, and I'm excited to be joined by our guest today, Curtis May. Curtis is the host of the Practical Wealth Show podcast and the creator and owner of Practical Wealth Advisors. Curtis has been planning for individuals for more than 35 years. He is passionate about helping his clients save money and live their very best life right now. The primary focus of his financial planning firm is to help individuals and families become financially free by following the principles of wealth creation that have endured for centuries around the world. Curtis, thank you for joining us tonight.
Thanks for having me. I'm excited to be here and share what little I know.
Hey, come on now. Definitely more than a little.
Yeah, it was funny. I recorded an episode for my show, and I was like, what are the things I would have told my younger self? And it was a short one, but it was like, there was some stuff. I wrote it out, and then I started freelance, so I guess I've learned a lot.
What are some of the things, kicking it off, jumping right into it, what are some of those things you would tell your younger self with the wealth of knowledge you have today?
Yeah, I would have, I wish I understood the difference between saving and investing. And what most people think is saving, they're really investing. And truth be told, they're not even investing, they're really gambling, they're really speculating. So, because they think putting money in, like I thought mutual funds and IRAs and 401ks were the greatest instant sliced bread till I read a little purple book called Rich Dad Poor Dad, and I started to understand how they were taxed, how they worked, savings. Savings, saving 15, 20% or more of your income, which is one of the principles that we teach. But why do you save? Because you need liquidity, use, and control of capital, right? And I thought that I was building this nest egg that I could live off of one day. So I'd put all my money, I had direct deposits out of my commission checks into like SEP IRAs, right? But business is fluctuating. I had an office, I had a secretary. I'm talking about, I don't know, 25-ish or so, I'm still within my first 5 or 6 years in the business, and business goes up and down. I had it when I needed money because I didn't have savings. What I have to do, because I thought it was savings, liquidate my qualified plans, pay the penalty, pay the taxes, sell my shares, and I'd have to do that back and forth. So I would have saved, and I would focused on liquidity use control. I don't agree with the idea of retirement, right? So that is not an objective. Retirement means to put out of use. So really what I focus on and what I focus people on, especially young people, is financial freedom, right? Which is what y'all talked about, right? Financial freedom is a capability, right? Which is passive income greater than expenses, right? And it's hard to reach a target you don't have, right? So most people don't have that. Jim Rohn calls it being able to live like you want to live from the income from your personally invested assets. So if you focused on what your outcome you want, that would totally change what you did on the daily with your money, what you focused on, because what typical advice doesn't teach you to do that. It teaches you to lock money up for 30 years and hope the market does well, but it's not designed for you to become financially free. So that could literally the opposite of everything I learned, I would teach myself to do. I taught about term invested difference, and I wished I'd have known about whole life. I specialize in, showing people how to use properly structured whole life as a privatized banking system. And I didn't discover that till I was 40 something. I had my insurance license I was 20. Okay. So I'm pissed, to say the least. All right. So that kind of stuff, just take more chances. My dad used to tell me, he said, listen, when you eat, your whole family eats. So try stuff. You learn by screwing up. So I did get that advice. So I did try that, where I would take chance. I probably went full time in business prematurely. But I had a great dad because he said, look, you never make your money, work for somebody else. And I've heard that since the time I was 8. So I never got that go to school, get a good job talk, and I always tell people I realized the NBA was not looking for 5'11" two guards and with a mediocre handle, right? Which would have been fine if I was like 6'5", but if you're 5'11", you need to be able to handle the rock better than I would. Could have.
Hey, come on now.
I was all right. I mean, I could put the ball in the hole, I could defend. So my coaches say, listen, if you score 20 and your man scored 20, that's 0, right? So if I scored 20 or 30, I had to hold you to 15, and then that's a win. So I had, he instilled that, give me the best guard, let me shut him down, that kind of stuff. So, and I've kind of brought that competitiveness into business, of working at getting better, trying to compete, trying to, go against typical financial advice. So I like that whole David and Goliath thing. So that's what I do.
And it's funny you mentioned that the NBA is not looking for a 5'11" two guard. In my case, the NFL is not looking for a 230-pound linebacker. Apparently, you got to be a little bit bigger than that. So playing sports, and this just across the board, early in life, kind of instills a lot of the skills that can help you excel in other areas of life, specifically business, sales, things of that nature. And you can kind of see, the development even taking place when you shifted your focus over to the business / financial freedom aspect of it. But one thing I want to go back to that you mentioned earlier, because I was one of those folks too. It took me a while to snap out of it. I had to read the Rich Dad Poor Dads, start listening to podcasts like the Bigger Pockets podcast, things of that nature, to really kind of understand, okay, there's more to this. But when you get out of college and you do get that, Fortune 500 or that first W-2 job, all they're preaching to you is, hey, put 3%, 6% into the 401k, and it's going to explode over time and allow you to have all this money that you go sit on a beach and quote unquote retire, right? That's what we're all working for, to go quote unquote retire. So when was the moment that you really snapped out of that? You mentioned it was around the 25-ish age.
No. I didn't. No, it wasn't that early. Unfortunately, it was. I don't know that it took me to, it was like mid 2000s where I read Rich Dad Poor Dad, but I didn't, I started to understand it. Because see, and I'm really, really starting to understand it like within the last 5 years, because I've been really getting into understanding taxation and how the plans work. So, because you have to opt out of these plans, right? But see, what people don't understand is that, where does financial institutions' advice come from? See, why do they teach you what they teach you, right? And so all financial advice is based around these 4 questions. So if you understand what's going on, you'll know what to do, right? So number one is, let's say you were starting your own company, mutual fund, bank, whatever. And so you need to attract capital into your entity, right? Into your fund, right? So that's step one. You need to attract money. Then, how often would you want them to put that money there? Every pay, right? Every time they got paid, right? Direct deposit. And then you gotta. How long do they want you to leave it there? As long as possible, right? And when do they want you to take it out? Never, or slow as possible, right? So now, would they, meaning the financial institutions, would they ever do that? Would they ever put money into something that they can't touch for 30 years?
No.
Would they leave it sit and hope the market goes up? No. Would they not put something in that generates cash flow back to them? Okay. So if they would never do that with their money, why should we do that? Right. And so the question becomes, you have to think about what's going on, because it's hiding in plain sight. So how do they get you to do what they want you to do? Well, they teach you stuff like dollar cost averaging. You're in it for the long haul. The stock market always goes up. You're going to build this nest egg at retirement. It's only a paper loss unless you sell it. I mean, all this BS, right? And so because here's how what I found it works now. And you got to make up you got to do your research. So I'm not giving any advice on this thing. I just want you to understand how it works. So I was reading something. 90% of households in the U.S. make, what is it, less than $120,000 a year. 90%. Okay.
That's crazy.
So now let's say you put 10,000. So that means your effective tax rate is like 12%. 12, like, if it's 100, it's like, 8.8. So it's between 8 and 12%. So if you put $10,000 a year in, or $400 a pay into your 401k, well, you're going to save money in taxes. Well, what's 12% of 10,000? $1,200. Okay. So what do qualified plans do? They defer taxes. And what's the more accurate word? Postpone taxes. Okay. So you got to ask yourself, will the government need more money or less in the future? Will some
Probably more.
Probably more, right? So that means taxes must go up or down.
They got to go up.
And who controls the rules in a qualified plan?
The plan holder, the
The,
plan
the government. No, the
government.
government, because it's the rule. So if they need more money, can't they just change the rule and change the taxes, and the money comes out as ordinary income? So let's say you are fortunate and you have $1 million, $1.5 million, very fortunate, very lucky. All right. So now you're making $80,000 a year. So the safe withdrawal rate is 4%. So that's 40,000 a year if you have $1 million, and you, not even counting inflation, right? Because the 40,000 or 80,000, probably you need 160,000 to buy what $80,000 buys today, which means you have to take more money out to maintain your standard of living. So now you could be in a situation when you pull it out, you could pay 20-30% tax on it. See, so you gotta see the whole thing, but nobody looks at that part of it, because the mutual fund companies don't want you to know that, because they want to charge you fees for 30 years. So you've got to understand, so if you're, what we talk about is financial freedom and you want to buy assets, well, there's 4 asset classes: business, real estate, paper, and commodities. Gold, silver, oil and gas, that kind of stuff, agriculture. And for the I call it the ugly classical triangle: business, real estate, paper. So if you break down the Forbes 400, or you stay like the millionaire next door, they don't get rich in the stock market. They don't get rich maxing out their 401k. They build businesses, and they buy real estate. So guess what? That successfully clues. So now the challenge is, it's not easy. And people want an easy button, because the powers that be teach you don't have the time, you don't have the temperament, you don't have the training to personally manage your money. So it's complicated. Give your money to us. You just go to work and just let us direct deposit out of your paycheck into this qualified plan. And so the people that work with me, they've kind of rejected that. So people that find me, their objective is work optional income, right? And so they want cash flow, and they don't want it at 65, right? They want it like 10 years or less, right? So they have to become more involved or active, because one of the things that we teach is in line with what I'm sure you're teaching your clients. Investing is about becoming something. It's not about buying something, right? So you start listening to Bigger Pockets, so you become an investor, you become a business owner. It means you got to learn some stuff, you got to transform your thinking, you got to learn some new skills, and transformations hard work. But you know what? It's easier than being broke, though, right? And so that's why. So you gotta. It's a choice, and that's, you gotta decide, if I want to be in control of my money? Do I want to follow what we call the 3 rules, right? Invest in what you know. 3 rules of investing: invest in what you know, or invest in knowing. Okay. So people say, what should I invest in? Probably a course, probably a mentor, probably some books, probably an Audible mirror. You got to probably, a phone where you can download podcasts and stuff. That's your first investment. They don't take any money. Once you figure out what you want and why, then everything will line up, especially if you get the right coach that teaches, what I'm talking about. And so invest in what you know, invest in what you can control. Rule number 2, okay? What you can influence the outcome of. Does it cash flow? Like, because if you're getting cash flow, isn't your risk coming down because you're getting your money back every month or every quarter or whatever you're, whatever you're investing in? Because if you look at Mr. Wonderful on, Shark Tank, what's the first thing he wants to know? I put money in my deal. How soon am I getting my money back?
He wants a royalty. He wants a royalty until his money comes back.
Right, but he wants his money back so he can do what? Put it in something else and then get that back and put it. That's called velocity of money. See, so we're taught. Let me get the third rule before I forget. Is it's what you can control, what cash flows, and the third one is don't chase returns. So I would argue most people are chasing returns, and what's his name? Warren Buffett. So you've heard of Warren Buffett, right? Have you ever heard of Benjamin Graham?
That's who he learned from. He actually wrote the book that Warren Buffett likes referring to.
Yes. So the Intelligent Investor or in security analysis, right? So first chapter in that book is speculation versus investing. And he was talking about securities. So that's interesting in and of itself, right? And so Ben Graham said, this is him and Charlie Munger, they're Graham value investing disciples. So the first chapter in the book says investing is something you put your money into where you have safety of principle. Okay? So if you put in 10 grand, you put in 100 grand, your principal's safe. You're supposed to get back 100 grand. And you have a reasonable opportunity to make a profit. He says if it doesn't fit that definition, you are speculating. So now hold that definition that most people think they're investing, but they're not really investing, they're speculating, because there ain't nothing guaranteed. There's no certainty. Their principal ain't safe. And I'm not saying you shouldn't speculate, but it shouldn't be with like 95% of your money, right? And I'm not even against the stock market. I'm against being ignorant, being not knowing how stuff works. And that's the key. And so you've got to make a decision that I want to know. And a lot of people, like I tell people, look, if somebody calls me and you don't think you want to do all that, read a book a month on money, all the stuff Kurt's going to have you do, don't call me. Okay? If you think Dave and Susie can walk on water and I just want to go to work and max out my 401k, I ain't your guy. Okay? Because I'm expecting you're going to learn some stuff. It's your money. It ain't my money. So it can't be more important to me than it is to you. So that's my story. I'm sticking to it.
Hey, come on now. So I want to unpack that. You just spoke about a lot, and I agree with a lot of the different principles. One piece I want to come back to, not right now, but just getting over that fear aspect initially, right? Because when you're doing the 401k, it's what most of the people around you are doing. And so that can feel like, hey, I'm on the right path. I've got the nice job. Let me go get a solid car. This thing's going to take care of me, even though we know that it's, living expenses are going up. So I want to come back to that piece later. But what you talked about, investing in what you know, what you can control and not chasing returns is huge, right? When you talk about what you know, I think Warren Buffett is one of the best at doing this, right? He only invests in companies that he feels comfortable owning forever, right? The Coca-Colas of the world, the McDonald's of the world.
He knows how it works. If they don't understand it, they don't buy it.
Exactly. Like even all these tech companies that have blown up, he's purposely stepped aside. He's like, hey, I don't necessarily understand this. I don't want to take part in something I don't understand. And breaking that down to the level of some of the individuals in our audience, we focus heavily on the real estate aspect. It's just how I got started. So it's kind of how a lot of conversations go. Mm-hmm. And real estate, one of the things I always recommend for somebody is, hey, instead of going to try and do a syndicate, or instead of going to try and buy like a huge, apartment on your first deal and pull everybody's money together, you need to learn first. Go do a house hack, right? Go buy a home, live in one unit, rent the other unit, and learn, and then start to use that knowledge for something else. And then the other piece about chasing returns, this has gotten a lot of people in trouble. And I'm not going to lie, when I was early in my investing, I was one of those, right? When you talk about returns, I used to live in Louisville, Kentucky. And so investing out there was a lot cheaper. And I still in areas, but I was investing in kind of like the C neighborhoods because the returns were crazy on paper. I'm like, man, 500K for a 12plex, this is going to make crazy money. But then when you realize is, hey, this is not going up in value as fast as the other neighborhoods. It's a lot of headaches. And it's because I was chasing the return. Whereas right now I'm in Atlanta, Georgia, and investing out here, this is a major metro, investing in top neighborhoods where the value is going through the roof. There's not the headache tenants. Did it cash flow as much as the other ones? Not so much. Had to be a little more creative. And to your point, not be lazy in the mind, but work at it and kind of figure out strategies. But now that we've stabilized a couple of these, 2, 3 years in, it makes way more sense. And so that's a huge principle. I like that. Invest in what you know, what you can control, and don't chase returns.
That'll keep you out of so much trouble. Okay. And investing is a team sport. All that stuff. I'm a big, especially the first 4 books of Rich Dad, Cash Flow Quadrants. Probably my favorite is Rich Dad's Guide to Investing, and then Who Took
Mm.
My Money, where he goes over the velocity of money formula, right? Because kind of what we teach. Because see, in our process, investing is last. So there's 5 things. Investing is number 5. See, the problem is people start there because that's sexy. And I always tell people, like I send them to you for example, for investing, that's offense. That's making money, that's growing, that's driving the ball down the field. Curtis is the defensive coordinator. I'm here to make sure you don't lose money. Okay. I'm here to make sure you understand the difference between an asset and a liability. I'm here to make sure you know how to manage cash flow. You know how to do a good performer. I'm here to make sure that you're properly insured. I'm making sure you're saving 15, 20% or more, and you've got 3, 6, 12 months of liquidity. See, that's the foundation. And so now once you have that, boom, you can let it rip because now you build a house on rock. And so one of the things that I preach is that your financial plan precedes the business plan or the investment plan. And so as I work with investors and small business owners, they could be killing it, hundreds of thousands of dollars a year, but they don't have enough liquidity. They don't have proper insurances. They don't have. I had a person had 6 figures of. She had probably like, what did she have? Like $3 million worth of real estate, over 6 figures in cash flow, and she says, "Well, I got 4 or 5 LLCs between the properties that she had." And then I do this little 1-page financial plan. You can see the principles. Like I talked about the 5 principles. I show them that and we make sure they're filled in. And I said, "You have umbrella insurance coverage?" No. Well, LLC guy. I got the LLC. Is that limited liability company? Emphasis on limited. Okay. And so your first line of defense is, I introduced somebody to give her like an $800 a year, $2 million umbrella policy. So now if somebody falls on one of your properties, insurance is your first line of defense, right? So my first principle is save. The second principle I teach is maximum protection, right? So I look at all their insurance, even the stuff I don't do. I understand all. I don't do all of it, but I understand it all. And I have experts because investing is a team sport. But you got to look at, you got to protect your stuff, right? Because life, you're going to have 1 of 3 problems. You're going to live too long, you're going to die too soon, or you're going to get sick, or you're going to get sued. Right. And so you've got to, because planning is provisioning. Like you can't have a plan that only works when the sun is out, right? Because it's going to rain, right? And you're going to have storms, right? So it's more so preparation with knowledge. Most people don't have access to capital. So for example, I teach to have 6 to 12 months of liquidity. So my clients that had that when COVID happened, and they didn't have good tenants, and then the government made it legal for your people not to pay you, that's a problem. Because the mortgage company didn't waive their money, did they? They still want to get paid, right? So now if you're not getting rent, where's that coming from, right? So now you got to scramble and get PPP loans, wherever, all that kind of stuff, and go through government stuff. But if you had liquidity, guess what? You could make those payments, and if your tenants stayed paying, you have opportunity now to not take advantage of, but to help the people that were losing their property for pennies on a dollar because you had the liquidity to solve their problem. See, because if you have money, opportunities will find you. And so too many times we stay broke and we don't value cash. I was like, oh, I don't leave it at a bank. It's not making any money. But it don't need to be making money. You know how much money Buffett has in cash? He's got hundreds of millions of dollars in cash right now. So why is that? Pray tell. I don't know, but I think he expects something's going to happen. He wants to have some money to take advantage of when the stuff hits the fan, I think, so, we don't really look at economics, like macroeconomics. I try to teach people to think from see the whole field, right? So I, where you see the whole, like Aaron Rodgers, see the whole field. You got to see the economics. You got to see how the Fed distorts things and what that does to interest rates and all that kind of stuff. See, Jim Rohn said economics is major. A great book I have people, they want to really understand real economics is Economics in One Lesson by Henry Hazlitt. I will give that to a high school senior, or college, and it's just, it's very basic, People think economics is like they think people that are economics majors and all of these PhDs at the Fed are all, PhDs in economics. They don't know enough economics to get out of a paper bag. I mean, they're it's like all theory. They don't know, almost cursed. They don't know anything, right? And common sense. Economics is from the Greek word, I always pronounce it wrong. I think it's called economos, right? Which just means household manager, right? And so you can't control hear me guys, you can't control the economy at large, but you all have a personal economy. And you can't control that. You can control your production and you can control your consumption as a family unit. If you want to produce more, well, how do you do that? Well, Curtis, I need more money. Well, money follows value, right? So if you want to make more money, you got to be able to be of more service. You got to be able to solve more problems. So that's why you're working on personal development, because entrepreneurs solve problems for a check, right? And so the bigger the problem, the bigger the check. So you don't want to run from problems. You want to solve problems. And in capitalism, you solving their problem, they value your solution more than their green dollars. That's in exchange. That's capitalism, And so a lot of people, we've got a lot of young people, oh, capitalism is evil and blah, blah, big business. That ain't capitalism. That's corporatism. Capitalism is you and I out here hustling, out here in the street, trying to make money. And so that is the solution, okay, to the problem, okay, to people like you and I. That's the solution. That is not the problem, okay. And don't get me started, but so let me ask me a question. I'm gonna
No, you're good. No, Curtis, I think
Curtis rant. I'm on a Curtis rant. I want to
no, this was good though. I love what you just did, right? Which is breaking it down to a level where everybody can understand it. Because when you start talking about investing and owning a business potentially and things that nature, people can blow it way out of proportion, and then they start to almost overcomplicate it in their head. And then in real life, hey, I need this, I need that person. But when you talk about what a business is and what economic is, the way that you just broke it down, you first got to handle your household. And
yeah,
before that, you got to handle your own. So one of the first things I had to learn is right along the lines of what you said. Hey, where's my money going? Right? Like
yeah,
the first step I took was simple. It was downloading this app called Mint, hooking up all my accounts in there and seeing, okay, my money's coming in. Where's it going? How can I start to save? Then I stumbled across this book called Profit First that talked about percentages and different bank accounts. Started doing that and have been doing that for close to a decade now. And it's been incredible. I just tweak the percentages every so
that's the
often,
game changer.
but it
I
makes
do
it
that.
simple.
Yeah, I teach that. We have our own version. We call it cash flow mapping, but same concept. And
Mm-hmm.
having the multiple accounts, we call it telling your money where to go instead of asking where it went, right?
Hmm.
And so I'm kind of like the anti-budget, because see, budgeting is like driving your car looking through the rearview mirror. Okay, even your P&L, you need that, but you're still looking at history, right? And so what you want to do is, so you look at profit first. You got money coming in, I've got profit, I've got taxes, I've got owner pay, I got operations, right? And so you got to say, okay, look, whenever you figure out your taps or your percentages, because I do it. I mean, I'm religious. My accountant was like, look, you're making too many transactions, because I want to move it as soon as I get paid, right? Right. So he's
Same.
like, no. But I'm a nightmare for my bookkeeper, right? So I got to do it. Yeah,
I got my
exactly.
breakdown right here. I got
Right?
my breakdown right here. I
Every
keep it on
time
my
I
desk.
get a revenue, it's like, okay, I see it before it hits, and then I in my journal, I'm like, okay, all right, because I'll do 15. So I'll tell you mine is 15% to the house, to Curtis, off the gross revenue. I do 15% for taxes, which I probably need to raise. Well, if I want to raise that, I'm gonna raise my profit, right? I pay myself 35%, and then I try to run the business on 35. And so it's accounted for. And then out of those, I'll take, out of the 35, I'm going to put a certain amount into, I have a business emergency fund. And, I want to keep at least a month and a half ahead, because, if I have a slower month, I still have assistance to pay, and I got office rent, and and you can't be aggressive as you need to be when you're broke, right? So you've got to kind of manage your, because see, the game is won and lost with cash flow management. That is the game right there. And so most people in the financial world is tedious, and they don't want to do that. They're like, they just want your assets under management. How much you got? We could do better. Why don't we move that money over here to us? But I found for me, and then for the people, even if they make hundreds of thousands of dollars a year, I start with cash flow, because because I want you to save, but I said, oh, I want you to save 20% of your income. But I have to find, what I do that's different is I find the money. See, because most people give most of their money away. See, it's the cash flow part, but the other part is what we call wealth transfers, right? And so transferred money is money that you're losing unknowingly and unnecessarily, right? So unknowingly, you don't know, but unnecessarily means you can fix it if you knew, right? And it's literally costing for households $1 to $3 million. Okay, once you understand opportunity costs over their lifetime, and businesses $5 to $10 million. Okay, so I'll give you they're five. Now I'll hit them real fast, and we can go
Please.
wherever we want to go. So the after cash flow management, the top five, and it's like 15, but the top five are how you pay your mortgage. Okay, so doing bi-weekly, sending in extra payments, all that's complete waste of money. Stop doing it. If you're doing that, stop doing that. Okay. Equity has no rate of return. All right. So, and it's good for you pay extra payments, is good for the bank. But here's the other side that was good for the bank is bad for you. Okay. Because you see the house or the real estate as the asset. To the bank, that's collateral. And their asset is the note. Right. And so if you pay down the note balance, you make it easier for them to foreclose on the asset because you have more skin in the game. Right. So you got to kind of, it's counterintuitive, but stop doing that. Okay. Taxes. Number one, wealth transfer is taxes. A transfer, it means that money's leaving your account, your asset column, and going to the asset column of the Treasury Department. Okay. But not just the money, it's the opportunity cost of the money. So let's say you have a $20,000 tax, and let's use an easy number. So let's say y'all could get, is it unreasonable to get a 12% cash on cash return on? No, right?
That's reasonable.
So if you could get 12%, that means your money would double every 6 years on average, right? So that means if you spent $20,000 that you had to get a government that you didn't have to, and you could have made 12%, then that means in 6 years, your 20 grows to 40, 80, 160, right? 320. And so that never stops. It's just not working for you because you gave the money to a third party. But the opportunity cost never stops. And that's where I'm saying we transfer away millions of dollars. How we fund retirement plans is, to me, everything over the match is a wealth transfer. Okay. How we pay for college, 529 plans and such, and how we finance things, 35 cents of every dollar leaves our household in the form of debt to others. That's why we teach how to be a bank, because everybody's chasing returns, but you need to, if you got a bucket and it's got holes in the bottom, before you turn the volume up on the faucet, let's plug the holes first. So what do I do? I'm the hole plugger guy, right? That's where we start. We start with, because if you want to create maximum wealth, you have to create maximum efficiency first. Stop giving money away. And then so you plug the holes. Now, even if you don't even work harder, you're more efficient and your money is still growing. But now if they're, working with you and they're learning about money, now you're turning up the volume, but you're not having it run back out the back door. So that's kind of the order. Manage your cash flow, find money that you're losing unknowingly, unnecessarily, so that you can save it. And then saving starts velocity. Like you have to save it. So we call it capitalized. You have to have capital to invest. You need to use other people's money, but you need to borrow out of opportunity, not out of necessity, right? So if you got 50,000 and you can get 50,000 from the bank, then you use their money and leave your money alone, right? But and because banks loan money to people that don't need it. So you
True.
want, you know what I mean? So you want to be in a position where you don't need it. So you have to have the good habit of being a good steward of your resources, saving money like you're talking about, managing your cash flow, and then finding little enterprises, because people think investing like a business is this. Like I tell kids this. I'll say, listen, you in Philly, I'm from Philly, right? So you see people that sell water on the street. I used to say kids, but now it's people. And or I'll go play ball, and this guy I was playing with, he would come out. He had his son there on the court. We playing ball. He's got a case of water, case of Gatorade or Powerade, right? And he sell water for $1, Gatorade for $2. Well, what's a case of water cost? $4, $5. How many in a case? 24. You sell each one for $1, $24. Well, the investment was the $4 or $5 to buy the water so he could sell it. That's a business. It's that simple, right? And Jim Rohn says profits are better than wages. So he made a profit while he was having fun. And then, $2 for the Gatorade because it costs a little bit more money. But that's when I say get a business, I'm not, y'all are too complicated, and just, you need a what do they call it, side hustle. You gotta, because you have to learn how to make money, right? You gotta learn how to sell. You gotta learn how to market. You gotta learn how to. My kids are doing a lemonade stand. I go, all right, they're. I said, well, they want to hang up, and so I want to get paid because I'm holding the sign. I said, you don't get paid. I'm like, because they're for holding up the sign. You just walked up and you want to hold up the sign and yell, and you want to split the money. That's not work that way. And I said, well, who bought the lemonade? Okay, well, you got to subtract the cost of goods. I literally was having this conversation last week. I'm breaking it down. So listen, if you made this and made like $24, okay, we ain't quite make $24. How much does the lemonade cost? Okay, and then you get to split it after you pay for the stuff, so you go out and buy some more lemonade. So you have to teach these kids these little lessons. So I'm doing this to like 12-year-olds. This is last week, breaking it down. And so, and I guess what, I'm gonna start bringing more. We're gonna play cash flow every week. So I'm
Hey,
a
come on now.
real capitalist from my
And
neighborhood.
Curtis, I gotta say, man, like I could go all day because these lessons and the different pieces you're talking about, our backgrounds are very similar. I actually lived in Philly for over a decade. That's where I went to high
Oh
school. I
wow!
played football at Temple University in North Philly. So, you probably recognize the 610 number, but yeah, it's
I'm from 12th and Master, right? So I grew up in Yorktown, where that little neighborhood behind Temple. I
of
used to play
course.
ball with McGonigal Hall with the before they built the Lagora Center. I would play ball, with some of the players that played at Temple when I was still in high school up in McGonigal. So that's my spot. That's my stomping ground.
Wow. Dude, this is pretty cool. No, this is pretty cool. I still got 1,000 questions and I may get to ask one or two of them, but I want to open it up to the group because we do have other individuals on the line that are actually looking to call in and ask some questions. So I'm going to open it up right now. And if you want to call in, feel free and or drop your question in the chat. I will pause for a second
I see a couple of questions.
and we will go to question number one. So I see one in the chat. If we are saying don't chase returns, what are the criteria for a successful investment?
Well, what's your objective? See, there's two types of investing. You can invest for capital gains, which means you're buying low to sell high, speculating, or you can invest for cash flow. And so
And
you
that question
can't,
was from Kareem.
yeah, you
Yeah.
can't eat, you can't eat equity, right? So if you can't, so my favorite thing, you can't eat equity. So we focus on cash flow so that you can become financially free. So financial freedom is a capability. So, if let's say, so we'll talk. I had a guy who's like, they're 57. He's like, all right, yeah, they didn't have $100,000 retirement. I said, listen, this whole I'm going to max out my 401k. That plan is not going to work. I hate to break that to you. All right, my sister calls me the party pooper. So but they're in a real estate coaching program that I'm doing fulfillment of. I said, listen, I said, well, could you net $400 on a house after all the stuff? I said, well, all right. Could you buy 2 houses a year for the next 5 years? I think so. Well, that's what your coach is there for. So if you've got 10 of those, that's $4,000 a month. That's so if that's what you're investing for. So you've got to decide what you want. So that really would dictate. See, because the criteria is what is your criteria. And it's different stuff because there's different asset classes, so it depends on what you like. Because investing is about becoming, it's not my job to tell you what to become. Like I said, I'm the defensive coordinator. You know all I do, like with my show, I just try to let people know, hey, here are the things that exist. I just did a show is franchising as an investment. I interviewed a franchise broker, you know, and he was talking about the spreads and the rates of return on the business, and how you can use other people's money for like 90% of acquiring the franchise, and what kind of returns you get after about 2 or 3 years, you know. So I'm my dad's son, so that was very interesting to me, because my favorite asset class is business. Is that a long answer, but does that make sense?
No, it makes a lot of sense. It makes a lot of sense. And I guess another question that came up, I had it from a little bit earlier, but when you talk about, you mentioned that you focus on the defense, which is what you need to even get started. But you have seen a lot of different investment strategies and interviewed a lot of people, across the spectrum. And so we are in a changing market right now, right? It's been years, and now we're still changing with the Fed continuing to increase rates, things of that nature. What have you seen work in the past? And if you had to recommend to somebody right now, similar to how you recommended to the individual to purchase 2 houses a year, right, to achieve their goal, if you had to recommend right now for somebody getting started, what is the top asset class that you'd be recommending right now? And this is a little bit of speculation, right? Nobody's going to hold you to it. But if you had to give advice now, what do you think?
Well, I think the fastest path to cash is business. And then you take your profits, you buy real estate. So there's an order, you know. But if you love real estate, you know, like, so for example, a lot of people wholesale and they flip. Like, I don't view that as investing. I have a coach friend of mine. She begs to differ, but I view it as a transactional business, because you're not generating cash flow, right? So there's nothing wrong with that. Just know what you're trying to do. So they'll hold one, flip one, hold one, wholesale one, but they know the wealth building is their buy and hold strategy, you know, and the tax strategy and all that kind of stuff. So I think that, you know, what are you willing to become? Because you can, like I said, that water thing I just said is a business, right? So if you can find, you know, I'm a big fan of, there's a guy, he's from Philly also, Jay Jones, the Black Entrepreneur Blueprint. And he says, you got to sell something, right? 6 things you can sell. He says, you can sell your physical products, your digital products, or your services, somebody else's physical products, somebody else's digital products, you know, affiliate marketing, whatever, and somebody else's services. Now, you have to learn how to do that, but that is the fastest path to cash, because sometimes you don't need money. You just, you know, if you know how to market, you're willing to get people, you can do it. There's people that need stuff to sell, and you can sell that, so you can get some capital, so you can save money, so you can buy assets. I got clients right now. I got 2 clients right now working at buying ATM machines. I got 3 clients that invest in ATM machines. You know, I've got people that, I got a guy that's making 6 figures. He's got 19 cars on Turo, and he has real estate. Okay. So it's truly about becoming. You got to find something that you like, that you're willing to put the time in. And, you know, so, but I would say if you're starting out, then if you got to sell something. Okay. And because I view that as investing, you know, you know, if you could buy it here, retail, wholesale, and sell it for this retail, boom, that's an enterprise. And that's where you start, in my humble opinion.
Absolutely. No, and I love that. And it's similar to my background and a lot of people on here's background when you look at this, because you do need to earn some income, right? And so business or I think this quote's from Mark Cuban. He said, if you learn how to sell, you'll always be able to have a job, right? And so being able to sell something is at the cornerstone of every business, right? You've got to have
Everything.
income coming.
Look, it's the cornerstone of dating. I mean, you
Yeah,
know, so,
true.
and so you create interest, overcome objections, and close. Right? No, just kidding.
Hey, come on now.
That was
Hey,
that was a run. I used to do timeshare when I was like 22. We used to go to James Madison. We used to go to JM's, and we would come from
yeah.
sales. All right, we go to JM's. Like, all right, you know, we just been in sales training all day long. You got to create interest, you overcome objections, and close, and come on with the number, right? Whatever, right? So that was. I was 22, guys, so don't judge me. I was 23.
Hey, come on now. Hey, we're not going to judge right now. That being said,
Right.
the timeshares are still alive and well. I just got back from Costa Rica yesterday, and I was getting sold a timeshare. And I said,
Mm-hmm.
guys, I'm good. I've seen this before.
Right.
but 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 to that point, those skills are going to help carry over to business. And the cool thing that I like about sales or even marketing skills is you can get paid to learn. I think way too many people try to go into a corporate situation or go into a W-2, and they're thinking only about the paycheck they're going to get. Whereas the focus, especially early in a career, should be on what skills am I going to get that I can use outside of this for a side hustle, as you mentioned, that can then buy me the assets to help me continue to grow. I can tell you that
Yeah,
when I was
don't
in my
just
W
be
2,
there. You gotta, I swear I heard it from my father, but I know Kiyosaki said also was work to learn, don't work for money. And
yes,
so
he said it.
one time I was in, where was I? I was doing some clothing store. I hated it, but I didn't want. We had a bar. I didn't want to do that, and I wasn't good at my financial business yet. So I was working at this clothing store. My dad, I was like, Dad, I hate it. It's boring. It's da da da. I'm complaining. He says, well, could you run a clothing store if you wanted to? How does it work? What do the owners think about? Where does the clothing come from? What is their pricing? And so now I went to work the next day with a totally different mindset because so now I like that. I'll look at the business and I like breaking apart. How does the business work? What's their marketing? How's their follow up? How do they get to the store? What's the pricing? What's the business model here? And so it's right there in front of you. I should tell one time I was in, so you know where I'm talking at Broad and Allegheny at McDonald's
Oh
up
yeah,
the street,
yeah,
right?
yeah, yep.
So one time I had just finished reading the E Myth, and I was talking to this young lady. I said, I said, don't just be here, right? There's people that pay money to learn how this works. So you're working here. How does it work? You can get to six figures making it working at McDonald's, right? Because you can work up the ranks, and then all of a sudden you're a general manager. You're running this guy's three of his stores, and those guys make $1.25 million a year. But you've got it's not what you're doing; it's where you're going and where your mind is at, right? And so, are you a wage slave that you feel you're here work for minimum wages beneath you? Are you in business school learning how to run an operation? Because this guy spent millions of dollars to own this thing, and all you see is I'm pressing a button to drop fries in the vat.
And that's the change in mindset right there that separates people, right?
Yeah,
Because it's
yeah,
really the top 20% that think like that have read the books, that have kind of had that mindset shift and helps you separate. Because if you think everything like that in life, like, hey, I can either learn from it or I can win, right? It's either going to be a lesson or a win. You'll find that you're a lot more successful in the end and that you are learning and getting better day by day.
yeah. It's the really top 1%. I hate to say it, but
Hmm.
and it's not a secret. It's just it's disguised as work. And rich people are wondering why you don't do this because they think it's simple, and you think the 99% think they're cheating, but they're saying, listen, we will show you. You've been around successful people, they're really open. They're not operating out of scarcity because they understand it's more than enough for everybody to have more than enough. See, politicians and college professor, they all are focused on scarcity and dividing people. But you have wealth has to be created before it can be divided, right? And so my message to people is, listen, stop. We're looking for other people to solve your damn problems. Learn how to create value in the marketplace. You won't have no problems. There's no, I always say, look, there's because people say, oh, I don't know how you're in financial services, and you know, I have people in the industry. We can't do it because where we come from, and nobody will invest money with us. That's in your mind, because that was in my mind. My first 20 years in the business, oh, white people won't do business with me. Listen, I tell people, look, don't. I don't know how we got here, but don't. You have to be good. You have to create value in the marketplace, and so if that's what because we don't tell people that you need to be like when my parents were kids, and even with me, I'm kind of tail end of baby boomers. We were told you had to be twice as good or five times as good to just beat out the other person, right? And so they don't teach that no more. So you think you can roll up pants sagging and all this, and you can't do. You have to be excellent. You have to be better, right? And I used to tell my daughter when she was in high school, I always felt that she was slighted. I said, you know what? I'm not running around marching, all this dumb stuff. I was like, listen, if it's a tie, you're gonna lose. So don't make it a tie. Still tell her
True.
that. Don't make it a tie. You gotta be better. You gotta be the clear choice that they're insane for not taking you. That's how good. And so you have to work, and that's a decision that you have to make. And so with whether it's with finances, whether it's with investing, that's why I say invest in knowing, right? Because as your knowledge goes up, your risk comes down.
True, true. And to quote a book that kind of summarizes what you were saying, you got to be so good they can't ignore you, right? You've got to be above the
Yes.
rest.
Yes.
But Curtis, this has been amazing. I think that the whole group has gotten a lot of value, and those that listen later are going to get a ton of value. But I had one more question for you to make sure that our audience can help you with some of your goals for this year. What's something that you're working on that our audience can tap into or assist with some of your goals?
So we are growing. My goal is to create over the next 10 years, build a team that I want to create 100,000 economically independent families. Okay. And so we're probably by the time this show airs, we'll have launched our relaunch our membership program called the Money for Life Club. And so, which you can find out if you listen to the podcast, the Practical Wealth Show. But that's what we're trying to do. I'm trying to teach them how to be the bank. We are but maybe by the time it airs, I'll have a book out called Money for Life: How to Thrive in Good Times and Bad. So I'm rewriting the book with the author who's like 82, and I love his stuff so much. I don't need to write my own book. I love your book, I told him, and I don't want it to die. So he sold me his last 15, 20 cases, and so I'm gonna I don't have the site finished yet, but I'm doing a free plus shipping offer on the book Money for Life that teaches my version of how to it was called infinite banking. So that's kind of what I do. I teach principle based planning, which you can find out if you go to our website, practicalwealth.net. I'll give you a link to it. And just help get the message out. I think that I'm mad because I think people just don't get good financial advice. And I hear such nonsense on the Instagrams, on the TikToks. Like, you can't get your financial plan in 30 seconds, and you take this one little idea and run with it. You don't know anything. Most of these people don't know anything. They're just trying to sell you stuff, and there's no product in of itself that can win for you. There's no, and again, investing is about becoming. So there's no product. Products are just tools of implementation, but it all starts with being between your 2 ears. So if I can get that across, if I can get y'all all to read The Richest Man in Babylon, okay, that, just basic stuff, Rich Dad, Poor Dad, Become Your Own Banker, I'll be very happy. And then just call me. So,
No,
because I'm going to make sure
Curtis.
to get implemented right.
Hey, come on now. No, no. Just based off of some of the titles that you've read and based off the wealth of knowledge and how you were able to so succinctly go through all the different concepts, I think that a lot of people are going to be reaching out. I'm definitely going to pick up the book. As soon as you have that link, please send it our way. We'll make sure we push it out to our audience. But it's been a pleasure having you on, and I can't thank you enough. But an abundance mindset to try to help others really achieve their goals of financial freedom as well.
Yeah, it was my pleasure. Thanks for having me, and hopefully, I help some light bulbs go off for some people, and that's what I'm here to do. I'm in a belief changing business.
Curtis, let's do it, man. Be safe. Thank you again for joining. And that is it for the